Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is the fourth most popular burger joint a good investment? In this video we will be analyzing if Wendy's stock is a buy. Could Wendy's, stock ticker symbol WEN, be on the move for a return to glory? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Wendy's. Wendy's was founded in 1969 with a single restaurant in Columbus, Ohio, by Dave Thomas. Fueled by his love of hamburgers, Thomas aimed to create a fresh, high-quality experience and named the company after his daughter, Melinda, whose nickname was Wendy. After going public in 1976, Wendy's continued to grow rapidly. Famous for its square hamburgers made with fresh, never frozen beef, the restaurant also offers a variety of sandwiches, salads, chicken options, and of course, the iconic Frosty. Today the company employs around 14,500 people in nearly 7,000 locations worldwide. Now let's look at the price action. Starting with the 1-year chart, we see that Wendy's had a CAGR of about -12%. Zooming out to the 5-year chart, we see that Wendy's had a CAGR of 1%. Wendy's share price has never really been a great performer, but the past year was brutal for shareholders. If we perform a backtest comparison of investing $10,000 in Wendy's versus the S&P 500, we find some poor results for Wendy's. In that comparison with the S&P 500, $10,000 invested in Wendy's would have grown to $14,761 or an 8% CAGR versus $21,877 or an 16% CAGR if invested in the S&P 500. This demonstrates underperformance for Wendy's. A Wendy's investment would have also been more volatile with a 28% standard deviation versus 18% for the S&P 500. Wendy's outperformed the S&P 500 in terms of the best year performance, for which Wendy's grew 45% versus S&P 500 31%, and worst year performance where Wendy's fell only 10% versus the S&P 500 18% fall. In terms of max drawdown, Wendy's fell 33%, more than the max drawdown of 24% for the S&P 500. Wendy's did underperform the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio due to its excess volatility. Now let's hop over to market share and take a look at Wendy's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that Wendy's is categorized under fast food restaurants. Expanding the fast food restaurants tab, we can see that Wendy's has one of the smallest market shares in this sub-industry and doesn't look to be growing. Let's dig in deeper by looking at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Wendy's, WEN, and see that the market share is just 0.23% out of the publicly traded food, beverage, and restaurant stocks currently in the market. This is very small market share. The 5-year market share CAGR for Wendy's is -0.84%. Though Wendy's is small, the real problem is that the company is losing precious market share. If we start in 2019, we see that the market share was 0.237%, 0.242% in 2020, 0.227% in 2021, 0.227% in 2022. and rose slightly to 0.229% over the trailing 12 months. It seems that Wendy's is struggling to hold market share amid current conditions. In this version of market share, we can also compare Wendy's with other companies or entire industries. When we type in restaurants, we can compare the market share data for Wendy's among the entire restaurant industry. Wendy's holds a small 1.49% share of restaurant spend. To put that in perspective, a little more than 1 cent of every dollar spent at a restaurant goes to Wendy's. More worrisome is the decline in restaurant market share. Wendy's is losing market share to other restaurants at a rate of nearly 2% every year. This does not bode well. Let's take a look at the fundamentals to learn more. Gross margin is 36%. This is on par with other fast food restaurant companies. Revenue has compounded at around 8% over the past 5 years and has reached over $2.18 billion most recently. Whoa, that is a lot of frosties. Looking at cash flow, we see a 6% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 3% CAGR. As a result, free cash flow has grown at a 5% CAGR. Wendys is actually doing a good job of growing free cash flow. Weighted average shares outstanding have fallen over the last 5 years, going from 235 million shares in 2019 to 212 million shares most recently. Wendys has been very busy buying back a lot of shares. Their commitments to share buybacks is really wonderful. I love to see shares outstanding trend down and to the right. Now let's look at return on invested capital. Return on invested capital has risen just slightly from 5.2% in 2019 to 5.9% in 2023. This is a very low value. While Wendys has become more efficient in driving profits from its investments over time, I would prefer that this value be much higher. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 19 days in 2019 to 10 days most recently, Wendys has gotten more efficient over time. Again, I would love to see this value closer to 0, but it is trending in the right direction. Now, let's look at Wendys debt. The net debt to EBITDA has fallen over the past 5 years, going from 8.4 in 2019 to 7 most recently. While this debt level is high, it has been improving every year. It will be very important for management to continue paying down debt here. Last, let's explore dividends. Current dividend yield is a very hefty 5.1% with a dividend payout ratio of 102%. This is a very high payout ratio and means that Wendys is paying out dividends that its earnings cannot support. This indicates that the company's dividend practice may be unsustainable. Dividends per share for this company have grown at a 24% dividend per share CAGR over the past 5 years and a 19% dividend per share CAGR over the past 10 years. This is amazing dividend growth, but at what cost? The fundamentals of Wendys are mostly okay. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Wendys. It is a restaurant company with a gross margin of 36%. The 5-year revenue per share CAGR is 9% and the 5-year free cash flow per share CAGR is 8%. This is pretty strong. Good gross margin and steady revenue and free cash flow growth is a great start for this company. A return on invested capital of 6% is low but growing. Next, the cash conversion cycle of 10 days is a little high but is continuing to improve. Concerning debt, a net debt to EBITDA of 7 means that it would take Wendys 7 years of earnings to pay back their debt. So from a fundamental standpoint, Wendys looks deceivingly nice. Now let's switch our attention over to valuation. Wendys is undervalued relative to the S&P 500 with a ratio of 0.7. The price to earnings growth, or PEG ratio, is 1.9, indicating that Wendys is slightly overvalued relative to their projected earnings growth. Wendys is a very interesting company because the fundamentals look so decent. The good gross margin, steady revenue and free cash flow growth look promising, as does the growing return on invested capital and falling cash conversion cycle and net debt to EBITDA. However, the big concern for me is the falling market share. Wendys is so small that an 8% revenue growth or 9% revenue per share growth is not keeping up with the rapid growth of the restaurant industry as a whole. Put another way, customers are spending less and less at Wendys to eat, meaning that money is going elsewhere and strengthening other businesses. The one draw Wendys does have for some investors is its dividend. Currently over 5% and growing about 19% per year, their dividend certainly seems enticing. However, with a payout ratio more than 100%, Wendys literally cannot continue growing dividends at this pace. If Wendys can find a way to restart revenue and market share growth, then the story changes for the positive. However, that is probably going to require reinvesting the free cash flow that has been supplying the dividend increases and share buybacks. Otherwise the company continues to be a value trap in my humble opinion. For me, Wendy's is not going on the watch list. Many thanks for watching. What do you think about Wendy's, and please be sure to let me know what other companies you want me to analyze. Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.